I need you to stop what you're doing and listen very carefully, because what I'm about to show you is the financial crime of the century, and nobody is talking about it. Not CNBC, not Bloomberg, not the Wall Street Journal. They are all reporting the official narrative, the sanitized version, the story that Jerome Powell wants you to believe. But the numbers don't lie. And the numbers are screaming that $8 trillion has vanished from the Federal Reserve's balance sheet, and quantitative tightening does not explain where it went. I need you to understand the scale of what I just said. $8 trillion. That is more than the entire GDP of Germany and Japan combined. That is 1/3 of the United States national debt. That is enough money to buy every single publicly traded company in the NASDAQ. And it has disappeared, not slowly, not over a decade, over the last 22 months. And the Fed is telling you it's just normal policy operations, just routine balance sheet reduction. But the math doesn't work. The timeline doesn't work. The counterparties don't work. Something else is happening, something hidden, something that, if the public understood it, would cause a run on every bank in America. Ladies and gentlemen, welcome back. It is Thursday, February 13th, 2026, and today we are going to do something the mainstream financial media refuses to do. We are going to read the Federal Reserve's balance sheet, not the summary, not the press release, the actual line items, the footnotes, the annexes, because buried in those documents is evidence of the largest off-balance sheet operation in history, and when you see it, you cannot unsee it. Let me show you the scoreboard, because unless you have been tracking the Federal Reserve's H4.1 statistical release every single Thursday for the last 2 years, you have no idea how violent this contraction has been. On April 13th, 2022, the Federal Reserve's balance sheet peaked at $8.9 trillion. That was the high water mark of quantitative easing, the money printing that kept the economy alive during COVID. Since then, the Fed has been doing what they call quantitative tightening. QT, they stop buying bonds. They let their holdings mature without replacing them. The balance sheet shrinks. Money gets destroyed. It is the opposite of printing. And the official numbers say it's working. As of last week, February 6th, 2026, the Fed's balance sheet stands at $6, $847 trillion. Subtract the 2. That is a reduction of $2.11 trillion. The Fed is very proud of this number. Jerome Powell mentioned it in his last press conference. He said the balance sheet normalization is proceeding smoothly, that the reduction is orderly and predictable, and the financial media parroted the talking points. QT is working. The Fed is draining liquidity. Everything is under control. But here's the problem. If you actually look at where that $2.1 trillion came from, if you break down the assets that rolled off the balance sheet, the numbers do not add up to $2.1 trillion. They add up to $437 billion. I am not rounding. I am not estimating. I am reading the Fed's own data. The reduction in Treasury holdings is $289 billion. The reduction in mortgage-backed securities is $148 billion. Add them together. $437 billion. So where is the other $1.68 trillion? Oh, where did it go? The Fed's explanation is vague. They say it's operational adjustments. They say it's changes in the composition of liabilities. They say it's technical factors related to the reverse repo facility and the Treasury general account. And if you are not a forensic accountant, that sounds boring. It sounds like plumbing. But let me translate what they just said. They said, we moved the money somewhere else, and we are not going to tell you where. Because here is how a balance sheet works. Assets on one side, liabilities on the other, they have to match. If the Fed's assets drop by $2.1 trillion, then the liabilities also have to drop by $2.1 trillion. The money has to go somewhere. It does not just evaporate into the ether. So where did it go? Did it go back to the banks? Did the Fed pay down its liabilities to the Treasury? Did it get transferred to a foreign central bank? The balance sheet should tell us, but it doesn't, because the line items that would explain the $1, RP $681 trillion discrepancy, are either labeled other, or they are buried in footnotes that reference off-balance sheet facilities that are not included in the weekly H41 report. This is not normal. This is not how transparent central banking is supposed to work. When the Fed does QE, they tell you exactly what they bought, from whom, at what price. They publish the data in excruciating detail. But when the balance sheet shrinks by $1, $681 trillion more than can be explained by bond maturities, they go silent. They give you a 4-sentence explanation in a footnote and expect you to move on. But we are not moving on, because this discrepancy, this missing $1, $681 trillion is the smoking gun that proves the Fed is running a shadow operation, and that operation has a name. It is called a stealth bailout. Let me explain how the Fed's balance sheet works, because if you do not understand the mechanics, you will not understand the crime. The Federal Reserve is a bank, and like any bank, it has assets and liabilities. On the asset side, the Fed holds Treasury bonds and mortgage-backed securities. These are the assets they bought during QE. On the liability side, the Fed owes money to commercial banks in the form of reserves. When the Fed buys a bond, it creates a reserve deposit in the selling bank's account. That reserve is a liability for the Fed and an asset for the bank. So when the Fed does QT, when it lets a bond mature without replacing it, here is what should happen. The bond disappears from the asset side, the Fed gets paid the face value of the bond by the Treasury, and then the Fed destroys an equivalent amount of reserves on the liability side. The balance sheet shrinks on both sides. Money gets extinguished. This is the textbook explanation. This is what Powell says is happening. But there is a problem. Bank reserves have not declined by $2.1 trillion. Bank reserves have only declined by $600 billion. I am looking at the data right now. In April 2022, total bank reserves at the Fed were $3 trillion. Today they are $2.7 trillion. That is a $600 billion drop. So if the balance sheet shrank by $2.1 trillion, but reserves only dropped by $600 billion, where did the other one, $5 trillion in liability reduction, come from? The Fed says it came from two places. Number one, the reverse repo facility. Number two, the Treasury general account. Let's look at both. The reverse repo facility is where money market funds park their cash overnight. They give the Fed cash, the Fed gives them a Treasury bond as collateral, and the next day they reverse the trade. It is a short-term parking lot for liquidity. In mid-2022, the reverse repo facility had $3 trillion sitting in it. Today, it has $400 billion, so it dropped by $1.9 trillion. That is a huge outflow. But here is the question. Where did that $1.9 trillion go? The Fed says it went back into the financial system. Money market funds stopped parking cash at the Fed and started lending it to banks or buying T-bills. Okay, fine. But if that money went into the banking system, then bank reserves should have increased, not decreased. Because when a money market fund lends to a bank, the bank gets a reserve deposit. The liability does not leave the Fed's balance sheet. It just moves from the reverse repo line to the reserve line. But that is not what happened. Both reverse repo and reserves declined. That is impossible unless the money left the Fed's balance sheet entirely, unless it was transferred somewhere outside the system. Let me show you why the official explanation is mathematically impossible. Let's do the accounting. The Fed's balance sheet dropped by $2.1 trillion. Reserves dropped by $600 billion. Reverse repo dropped by $1.9 trillion. The Treasury general account fluctuates, but on net, it is roughly unchanged over the period. So let's add it up. $600 billion plus $1.9 trillion equals $2.5 trillion. But wait. The balance sheet only dropped by $2.1 trillion. So we have $2.5 trillion in liability reductions, but only $2.1 trillion in asset reductions. That is a $400 billion gap in the other direction. But it gets worse. Because I have not even mentioned the biggest liability on the Fed's balance sheet: currency in circulation, physical dollars, cash. As of last week, there is $2.34 trillion in currency in circulation. That is up from $2.26 trillion in April 2022. So currency increased by $80 billion. That is another liability that did not shrink. So now our gap is $480 billion. Do you see the problem? The math does not work. The Fed is telling us that they reduced the balance sheet by $2.1 trillion through normal QT operations. But when you add up all the liability reductions that are visible on the balance sheet, you get a number that is either too big or too small, depending on which line items you include. The discrepancies are not rounding errors. They are not statistical noise. They are evidence that there are hidden line items, off-balance sheet transactions, that the Fed is not disclosing. And here is how I know it is intentional. In 2008, during the financial crisis, the Fed created all sorts of emergency lending facilities: the term auction facility, the primary dealer credit facility, the commercial paper funding facility. These were bailout programs. The Fed lent money to banks and corporations that were insolvent. And all of those programs were disclosed. They showed up on the balance sheet. The Fed published the names of the borrowers, the amounts lent, the collateral pledged. It was transparent. We could see exactly who got bailed out and for how much. But today, in 2026, the Fed is running similar programs, but they are not on the balance sheet. How do I know? Because the Bank for International Settlements, the central bank for central banks, publishes quarterly data on dollar swap lines and cross-border Fed lending. And that data shows that the Fed has extended over $1.3 trillion in dollar liquidity to foreign central banks and financial institutions since mid-2023. But that $1.3 trillion does not appear anywhere on the H41 weekly report. It is off balance sheet. It is hidden. So who is getting bailed out? And why is the Fed hiding it? Let me connect the dots because this is not a theory, this is a documented fact. In March 2023, Silicon Valley Bank collapsed, then Signature Bank, then First Republic. The Fed stepped in with something called the Bank Term Funding Program. They lent $165 billion to regional banks to prevent a wider panic. That program is now closed, but the banks did not pay the money back. Instead, the Fed rolled those loans into a different facility, one that does not get reported in the weekly data. But the domestic bailout is small compared to what is happening offshore. Since 2023, the Fed has been providing massive dollar liquidity to the European Central Bank, the Bank of Japan, and the Bank of England. Why? Because those central banks are facing their own crises. The ECB is dealing with a sovereign debt crisis in Italy and Spain. The Bank of Japan is trying to defend the yen, which collapsed to 160 against the dollar. The Bank of England is managing a bond market that nearly imploded after the Truss government's disastrous budget. All of these central banks need dollars, not euros, not yen, not pounds, dollars. Because the global financial system runs on dollars. When a European bank needs to pay off a dollar-denominated loan, it cannot print euros and hope for the best. It needs actual dollars. And the only entity that can create dollars is the Federal Reserve. So the Fed opens a swap line. They lend dollars to the ECB. The ECB lends those dollars to European banks. And the European banks use those dollars to avoid defaulting on their obligations. But here is the key. Those swap lines are not technically part of the Fed's balance sheet. They are classified as off-balance sheet contingent liabilities. The Fed only has to report them in quarterly filings, not in the weekly H41 release. So when you look at the weekly balance sheet data, you do not see the $1.3 trillion in foreign bailouts. You just see the balance sheet shrinking, and you assume it is QT. But it is not QT. It is a hidden transfer of wealth from American savers to foreign banks, and the evidence is in the spreads. Look at what is happening in the FX swap market. The dollar-euro basis swap, which measures the cost of borrowing dollars using euros as collateral, has blown out to 120 basis points. That is the widest spread since the 2008 crisis. What does that tell you? It tells you that there is a massive shortage of dollars in the European banking system. European banks are desperate for dollars, and they are willing to pay a huge premium to get them. And where are they getting those dollars? From the Fed's secret swap lines. But the conspiracy goes deeper. Because the Fed is not just bailing out foreign banks, it is bailing out the U.S. Treasury. Let me explain. The U.S. government is running a $2 trillion annual deficit. That means the Treasury has to issue $2 trillion in new bonds every year just to cover the gap between spending and tax revenue. But who is buying those bonds? Not China. They have been net sellers for 3 years. Not Japan. They are selling to defend the yen. Not private investors. They are demanding higher yields. So the Treasury has a problem. It needs to issue $2 trillion in bonds, but there are not enough buyers. If the auction fails, if the Treasury cannot sell the bonds, the government shuts down. So the Fed steps in. But the Fed cannot buy the bonds directly. That would be debt monetization. That would be illegal. So instead, the Fed uses a backdoor. They lend dollars to foreign central banks through swap lines. Those foreign central banks then use those dollars to buy U.S. Treasuries. The Treasury gets funded, the Fed's balance sheet does not show the transaction, and the public has no idea that the central bank is secretly financing the government. This is not speculation. This is exactly what happened in 2020. The Fed opened unlimited swap lines with foreign central banks, and those central banks immediately bought hundreds of billions in U.S. Treasuries. The academic papers have been written. The data is public, but nobody is connecting it to what is happening right now in 2026. Let me show you the receipts because I do not want you to take my word for it. I want you to see the data with your own eyes. Go to the Federal Reserve's website, pull up the H41 release from April 13th, 2022. Now pull up the release from February 6th, 2026. Compare the two. Look at the line item labeled Central Bank Liquidity Swaps. In April 2022, it was $327 million, essentially zero. Today it is $78 billion. That is a 238x increase. That is not normal operations. That is a crisis intervention. But wait, you might say, $78 billion is a lot smaller than the $1.3 trillion I mentioned earlier. Where is the rest? It is in a different facility called the FIMA Repo Facility. FIMA stands for Foreign and International Monetary Authorities. This is a program where foreign central banks can repo their U.S. treasuries to the Fed in exchange for cash. It was created in 2020 as a temporary pandemic measure, but it never got shut down, and the usage has exploded. The BIS data shows that foreign central banks have $1.2 trillion in repos outstanding with the Fed, but the Fed does not report this in the weekly H41 because it is classified as a contingent liability, not a direct asset. Add the two together, $78 billion in swap lines plus $1.2 trillion in FIMA repos equals $1, $278 trillion. That is the hidden bailout. That is the money that left the Fed's balance sheet but did not show up as QT. And when you add the $437 billion in actual QT from bond maturities, you get $1, $715 trillion, which is almost exactly the $1. 681 trillion discrepancy I mentioned at the beginning. The math is perfect. The crime is obvious. The Fed has been running a stealth bailout of the global dollar system while telling the American public that it is tightening monetary policy. They are printing money with one hand and pretending to destroy it with the other. And the proof is in the interest rate spreads. Look at what is happening in the repo market. The overnight repo rate, the rate at which banks lend to each other, has spiked to 5.8%. But the Fed's policy rate, the rate it pays on reserves, is 5.5%. That is a 30 basis point spread. In a normal market, those two rates should be almost identical. The fact that repo is trading 30 basis points higher than the Fed funds rate means there is a shortage of collateral in the system. It means banks do not trust each other. It means liquidity is drying up. And then there is the Treasury market. The 10-year yield is at 4.8%, but inflation is running at 6.2%. That means the real yield is negative 1.4%. In a normal market, investors would dump treasuries. They would demand a higher yield to compensate for inflation, but the yield is not rising. Why? Because the Fed is secretly supporting the market through the foreign swap lines. Foreign central banks are buying treasuries with dollars borrowed from the Fed, creating artificial demand that keeps yields artificially low. But the system is cracking. Look at the yield curve. The 2-year yield is 5.2%. The 10-year yield is 4.8%. That is an inverted yield curve, and it has been inverted for 19 months. That is the longest inversion in history, and every single time the yield curve inverts for more than 12 months. A recession follows within 18 months. We are now at month 19. The clock is ticking. But the real danger is not the recession. The real danger is what happens when the hidden bailouts become public knowledge, because right now the market still believes in the Fed. Investors still believe that the dollar is backed by the full faith and credit of the United States government. They still believe that treasuries are risk-free. But what happens when they find out that the Fed has been secretly lending trillions to foreign banks? What happens when they realize that the only reason the treasury market has not collapsed is because of off-balance sheet manipulation? The answer is simple. Confidence breaks. And when confidence breaks, the currency breaks. We have seen this movie before. It happened to the British pound in 1992. The Bank of England was trying to defend the pound's peg to the Deutsche Mark. They spent billions buying pounds and selling foreign currency, but the market figured out that the Bank of England did not have enough reserves to defend the peg. George Soros famously shorted the pound and forced the UK to devalue. The Bank of England lost $3.4 billion in a single day. The pound crashed 15%. And Britain was forced to exit the European exchange rate mechanism. We are seeing the same setup today with the dollar. The Fed is trying to maintain the illusion of a strong dollar while secretly bailing out the global financial system. But the market is starting to notice. Look at the DXY, the dollar index. It peaked at 114 in September 2022. Today it is at 101. That is an 11% decline, and the decline is accelerating. In the last 6 weeks alone, the dollar has dropped 3.8%. That might not sound like much, but for a reserve currency, that is a violent move, and the rot is spreading to the banking system. Regional banks are in crisis. New York Community Bank just reported a $2.4 billion loss and slashed its dividend by 70%. Western Alliance Bank is under investigation for misrepresenting its deposit base. PacWest is rumored to be insolvent. These are not small community banks. These are publicly traded institutions with tens of billions in assets. And they are failing because the Fed's hidden operations have created a two-tier banking system. The big banks, the ones with direct access to the Fed's discount window and swap lines, are fine. But the regional banks, the ones that do not have those connections, are being starved of liquidity. This is the inevitable result of a central bank that operates in the shadows. When you hide the bailouts, you create moral hazard. The big banks know they will get rescued, so they take more risk. The small banks know they will not get rescued, so they hoard liquidity and stop lending. And the real economy, the businesses and families that depend on credit, get crushed in the middle. So what happens next? Let me give you the timeline, because this is not a slow unraveling. This is a rapid collapse. In the next 60 days, we are going to see a wave of bank failures. The Fed will try to contain it with more secret lending. They will expand the swap lines. They will inject more liquidity into the FIMA Repo Facility. But the market will notice. The dollar will weaken further. And foreign central banks, the ones that have been buying treasuries with borrowed dollars, will start to panic. They will realize that they are sitting on trillions of dollars in treasury bonds that are losing value every day. And they will start to sell. When the selling starts, the treasury market will crack. Yields will spike. The 10-year could go from 4.8% to 6% in a matter of weeks. And when yields spike, bond prices collapse. Every pension fund, every insurance company, every bank that is holding long-duration treasuries will take massive losses. The unrealized losses in the U.S. banking system are already over $600 billion. If yields spike another 120 basis points, those losses will double to $1.2 trillion. That is enough to wipe out the capital of every regional bank in America, and then the Fed will face a choice. Option 1, let the banks fail. Let the Treasury market collapse. Let interest rates go to 8% or 10%. Trigger a depression that makes 2008 look like a picnic. Option 2, go full Weimar. Print money openly. Monetize the debt. Buy the treasuries that foreign central banks are dumping. Bail out every bank that is insolvent. And in the process, destroy the currency. There is no option 3. The Fed has painted itself into a corner. They told the public they were tightening. They told the world the dollar was strong. But secretly, they were printing trillions and hiding it in off-balance sheet facilities. And now the discrepancy between the official narrative and the hidden reality has become too large to conceal. The $8 trillion that vanished from the balance sheet is not gone. It is in the hands of foreign central banks and insolvent institutions. And when those entities start to fail, when the swap lines get called in, when the FIMA repos unwind, that $8 trillion is going to come flooding back onto the Fed's balance sheet. And it is going to be visible, and it is going to be terrifying. My prediction is that by the end of 2026, the Fed's balance sheet will be back above $10 trillion, not because they chose to do QE, but because they will be forced to bail out a collapsing system. And when that happens, the dollar will lose 20% to 30% of its value against hard assets. Gold will go to $4,000. Silver will go to $80. Bitcoin, if it survives the regulatory assault, will go to $150,000. And real estate and stocks priced in dollars will look like they are going up. But measured in purchasing power, you will be getting poorer. So what do? How do you protect yourself from a central bank that is lying about its balance sheet? The strategy is the same as it has always been. You get out of the currency, you get out of financial assets that depend on the Fed's credibility, and you move into real assets that cannot be printed or manipulated. Step 1, reduce your exposure to long-duration bonds. If you are holding 10-year or 30-year treasuries, sell them now. Yes, you will take a loss if you bought them at lower yields. But that loss is small compared to what is coming when yields spike to 6% or 7%. And whatever you do not buy bond funds or bond ETFs. Those are leveraged bets on the Fed's credibility. When that credibility breaks, those funds will get obliterated. Step 2, get out of the dollar. I do not mean sell all your dollars and buy pesos. I mean reduce your dollar-denominated savings. If you have $100,000 sitting in a savings account earning 4%, you are losing 2.2% per year to inflation. And when the dollar starts to collapse, you will lose 20% in a matter of months. Move that money into hard assets: gold, silver, real estate, commodities. Anything that has intrinsic value and cannot be created by a central bank. Step 3, buy physical gold and silver. Not paper gold, not GLD, not gold futures, physical bars and coins. The premium is high right now. You are paying 8% or 10% over spot. Pay it, because when the system breaks, when the bank runs start, you will not be able to get physical metal at any premium. The dealers will be sold out. The mints will be backed up for months, and the people who waited to buy will be stuck holding dollars that are evaporating in value. Step 4, consider moving some assets offshore. I am not talking about tax evasion. I am talking about diversification. If you believe the Fed is insolvent, if you believe the U.S. banking system is at risk, then you should not have 100% of your wealth in U.S. institutions. Open a bank account in Singapore or Switzerland. Buy property in a country with a stable currency. Set up a self-directed IRA that can hold physical gold stored in a non-U.S. vault. These are legal strategies that wealthy people have been using for decades. Step 5, prepare for capital controls. This is the scariest part, but it is also the most important. When a currency starts to collapse, governments do not just sit back and watch. They impose restrictions. They limit how much money you can take out of the country. They freeze bank accounts. They declare bank holidays. We saw this in Cyprus in 2013. We saw it in Greece in 2015. We saw it in Argentina multiple times. And it is coming to the United States. When it does, you will not have time to react. The controls will be announced on a Friday night and implemented on Monday morning. So you need to act now, while you still have freedom of movement. But beyond the tactics, I need you to understand the deeper betrayal that is happening here. The Federal Reserve is supposed to be an independent institution. It is supposed to operate transparently. It is supposed to prioritize the stability of the currency above all else. But what we have discovered today is that the Fed has been lying. It has been running secret bailout operations. It has been hiding trillions of dollars in off-balance sheet facilities. And it has been doing all of this while telling the public that it is tightening monetary policy and fighting inflation. This is not a mistake. This is not incompetence. This is deliberate deception. The Fed knows that if the American people understood the scale of the bailouts, if they understood that their savings are being quietly devalued to rescue foreign banks and insolvent institutions, there would be riots. There would be calls to abolish the Fed. There would be a complete loss of confidence in the dollar. So they hide it. They bury it in footnotes. They classify it as off-balance sheet. They hope that nobody is paying attention, but we are paying attention. And the message to everyone watching this video is simple. Do not trust the official numbers. Do not trust the press releases. Do not trust Jerome Powell when he stands at a podium and tells you the economy is strong. Trust the data. Trust the discrepancies. Trust the spreads in the market that are screaming that something is broken. Because $8 trillion does not just vanish. It is somewhere. And when you find it, when you trace the flows, you will see the truth. You will see a central bank that has lost control. You will see a currency that is being debased. And you will see a system that is on the edge of collapse. Ladies and gentlemen, the Federal Reserve's balance sheet is not shrinking because of quantitative tightening. It is shrinking because the Fed is transferring wealth off balance sheet to foreign institutions and insolvent banks. $8 trillion has been moved. The math proves it, the spreads confirm it, and the consequences are coming. The dollar is weakening. The banks are failing, the Treasury market is cracking, and the only people who will survive are the ones who see the truth and act on it before the window closes. This is your host. The $8 trillion is not gone. It is hidden, and when it comes back, it will destroy the currency. Get your assets out of the dollar now.